welcome everybody. Thanks for joining today. My name is Pinky Lumba. I'm your host for today's meetup. I'm a founder and CEO of Lumba Investment Group. I'm in the commercial real estate investing space with special focus on multifamily. I'm just gonna hand over the baton to Renika. So welcome again, Renika. Stage is all yours.
Thank you so much, Pinky. I do want to say, good evening, good afternoon. Hope everyone's doing well. Special thanks to Pinky and the Lumba Investment Group for allowing Advanta IRA to be here. I'm just going to go over just the general concept of self-directing, give you some information relating to the account types and some examples of real estate assets that you can do within an IRA or solo 401k. If you have questions, definitely feel free to type those in the question box. We can answer as we go, or we can allocate some time at the end to go through. So we're going to be talking about using a self-directed IRA or a solo 401k to invest in real estate. Again, my name is Renika Lightborn. I am one of the business development specialists here at Advanta IRA. I've been with Advanta as an employee for a little over 2 years now, but I'm also a client of Advanta for about 4 years. So self-directing is something I personally do. I'm very passionate about both being able to be both personally and professionally in the space, advocating that more people definitely use this as a strategy. If you have specific questions, if you want to do a deeper dive, talk through your scenario, definitely feel free to give me a call, send me an email, or you can always visit our website at advantaira.com for more information. Like Venki, I also have to do a little housekeeping, give you a disclaimer. I just know that at Advanta, we don't give our clients any tax, legal, or investment advice. All the information presented here today is just more so educational purposes. So we always encourage you to confer with your professional team, like your CPA, your financial advisor, and so forth. And of course, do your due diligence before you make any investments. So just a brief overview of Advanta and who we are. We've been in the business for nearly 20 years, and we take great pride in being recognized as one of the leading self-directed IRA administrators in the country. Our headquarters is in Largo, Florida, which is the general Tampa Bay area. But Advanta also has an office in Atlanta, which is where I'm based, but we do work with clients nationwide. We also have clients that use their IRAs to invest internationally if they choose. We have nearly $2 billion under our administration. One of the ways that we set ourselves apart from our competitors is providing you clients, that concierge style service, meaning if you have an account with us, you will have an assigned account manager, a dedicated person who's going to be there with you throughout the life of your investment. And then, of course, our educational platform. We have different guest speakers and experts just talking about the different investment options available to you. So I would encourage you to check out our website, look at our YouTube channel. It's a great resource for you. If self-directing is a new concept for you, or it's something that you've heard just sparingly, I just want you to take away three key takeaways. One, knowing that any IRA or former employer plan qualifies. Two, with self-directing, you choose the investment that works for you. So in this case, as real estate investors, if you want to do that fix and flip or that rental property. And then three, knowing that all of the income that's generated from that investment will flow back into the IRA. If there's any expenses associated with that investment, it would be paid by the IRA. So if you have rental properties, the tenant would send a check to be deposited into your IRA account with Advanta. If there's any expenses, say you got to pay property taxes, or you have to pay contractor to fix something, it'll be paid out of your IRA. So typically when I'm talking to a new potential prospect, they ask, well, why haven't I heard of a self-directed IRA? The most common reason is because, most IRAs are held by the banks and the brokerage firms. Their business model is the stock, bonds, mutual funds. But in reality, the IRS say that, hey, you can use your IRA funds to invest in a broad range of different investments. And this has been allowed since the 70s, since the mid 70s, 75 actually. There is $36 trillion in retirement savings, 12 trillion of which is in, IRAs. And then of that, less than 4% is actually in a self-directed account. So even though it's been around for a long time, there's still a lot of opportunities, for us to, as Advent, to grow the space, but also for you as investment providers or investors to kind of participate and use self-directing as a good tool or vehicle for you. So exactly what is a self-directed IRA? In its simplest form, the self-directed IRA just simply means that you as the account owner has complete control over the retirement funds. You have complete control over the investment decisions. And then of course, it allows you to diversify out of traditional markets like stocks and bonds. Some of the investments includes, it's not limited, but real estate, tax liens, tax deeds, notes and mortgages. You can certainly use IRA funds to invest in, say, private placement, which can include, a startup company or a startup bank or, a syndication project. You can use IRA funds to invest in, oil and gas. And we've also seen an increase in IRA holders investing in cryptocurrency. The list goes on in terms of what's available to you. You get to be as creative as you want to when it comes to self-directing. I'll touch on a few restrictions that the IRS reference that you cannot do in an IRA, but outside of that, the sky's the limit for you. So why do people choose to self-direct? You might look to self-direct for any number or combination of reasons. I'm just going to highlight 3 of them. One of which is if you have an old 401k that's just sitting idle, you can elect to roll those funds over to make your next investment, purchase that that property down the street from you, as opposed to taking out a bank loan or tapping into your personal savings. Another reason, the ups and downs in the stock market. No one can really time the market, no one has control over it. But as real estate investors, we know real estate always holds some value. So it again gives you the ability to diversify. It gives you the ability to invest in something that something that you understand, but also retain value in that real estate asset. And then finally, the tax benefits. Having those rents, those profits, those dividends flow back into that IRA account, tax-free or tax-deferred, depending on the type of account that you have. If you're a fix and flipper, if you do that fix and flip project outside of your IRA, when you sell that property, you're subject to taxes, capital gains. Whereas if you were to do that same investment in your IRA, those profits, gains flow back into the IRA without any tax liabilities. In terms of the different types of accounts that can be self-directed for individuals, know that any type of IRA qualifies. So the ones that you're already familiar with, like the traditional IRAs and Roth IRAs, if you're self-employed or have a small business or a side business, you can look to self-direct a SEP, simple, or solo 401k. I'll touch a little bit more on the solo 401k option. I know that's a vehicle that a lot of real estate investors like. Some lesser known accounts are educational savings account and HSAs. HSAs more so to cover medical related expenses. You do have to have a high deductible plan with an HSA, but it's a great avenue to self-direct and partner multiple accounts. And then of course, any former employer plan qualifies to be self-directed. So if you have an old 401k, 403b, or TSB type plan, you can elect to roll those funds over at any time. The only restriction is if it's a current employer and you're not 59 and a half, most times that employer or that plan administrator would stop you or prevent you from moving it. You can, obviously check with them to see if they would make an exception to allow you to do like an in-service rollover, in-service transfer. But typically, any former employer plans, you can move it without any liabilities or consequences. The key thing that you want to remember here is, the contribution limits varies between the different types of account. And then with a Roth, the distribution is tax-free in retirement. As it relates to solo 401k, there's so many different benefits as it relates to for solo 401ks, why real estate investors like it. Again, 401ks are designed specifically for, whether you're a sole prop, an independent contractor, or, you're self-employed, you're just starting a new business. It's very similar to a traditional 401k plan in that you have the higher contribution limits where, you get to contribute twice, once as an employee and, also as an employer to match. But you have the higher contribution limits up to possibly for 2021, it's 58,000. You have for the employee side, you can elect to have it as, deferred to get deductions, or you can have a Roth component. I know with the Advantage Solo 401k plan, you have a Roth component. The employee portion, you can elect to have it as after-tax dollars. And then, of course, UDFI. I'll explain what UDFI is, but a lot of real estate investors like that feature, especially when they're using leverage to purchase real estate in a solo 401k. As it relates to the contribution limits, so each year the IRS allow you to make an annual contribution. And then of course it varies based on the account type. For a traditional or Roth IRA, you can contribute $6,000 a year if you're under the age of 50. If you're over 50, they allow you an additional $1,000 catch-ups where you can contribute $7,000. If you have a set plan, you can possibly contribute up to 58,000 or 25% of the compensation. And then with a simple IRA, you contribute as an employee. The employer also match up to 3%. With a solo 401k, again, you get to contribute twice as the employee and the employer, where you can possibly for 2021 put up to 58,000 or 64,500 if you're over the age of 50. For an ESA, you can educational savings account, and this is again to cover any related expenses for education for your children or grandchildren. You can put in $2,000 per year per child, and then with an HSA, having a high deductible medical coverage, you can if you have single coverage, you can do $3,600, or if a family plan, you can do $7,200. If you're over 55, you have the option to catch up an additional $1,000. In terms of when it comes to funding an account, in addition to making an annual contribution, you have several options, one of which includes a direct rollover from a former employer plan. That's a tax-free movement of money for you. In that scenario, you would actually have to initiate the request to have those funds moved over. The plan administrator would send the funds over to Advanta Title in the name of your IRA. With a transfer, if you have an existing IRA, whether it's at your brokerage firm or your local bank, you get to decide exactly the dollar amount that you need to move over. In that scenario, Advanta, as the administrator, as the custodian, will initiate that request on your behalf. The only thing that we ask is, again, whatever dollar amount that you want to move over, you need to make sure that's sitting in a cash position, a money market position. So if it's currently tied up in a stock or a bond, you would actually have to liquidate to sell those shares to make sure it's sitting in cash. But again, it's just moving from one qualified retirement account to another, so there's no tax liabilities to you. You can move as much or as little as you want to, as many times as you want to or need to with a transfer or direct rollover. So when it comes to self-directing, it's near universal in terms of the things that you can do, but the IRS do have a few rules and restrictions that I want you to make sure that you're mindful of. The only two investments that you cannot make in your IRA is life insurance and collectibles. Collectibles being anything like antique, art, wine, stamp, anything of that nature. Everything else is on the table for you. That's pretty straightforward. We usually don't get a lot of questions about that. Where we do get questions, however, is what's called a prohibited transaction, or who the IRA is not allowed to transact with. And the IRA is not allowed to transact with someone who's considered a disqualified person. A disqualified person would be you as the account owner, your spouse, any lineal ascendants or descendants, meaning parents, grandparents, children, or grandchildren, any spouses, of your children or grandchildren, but also too, the IRA is not allowed to transact with any business or entity that's owned or controlled by a disqualified person. So the easiest way to remember, I just tell people, think opposite sides of the table, meaning if you own 123 Main Street today personally, you can't sell it to your IRA, or you can't take money from your IRA and lend it to your spouse or your child or your business. You can certainly buy real estate in your IRA as an investment, but you can't personally live in that property. You can't do any of the sweat equity to fix a property up. You would have to, you can oversee it, but you have to hire it out to a third party. The IRS, however, do allow you to partner with anyone. That includes yourself, that includes your spouse, or your business, or any lineal ascendants or descendants. Meaning, if 123 Main Street's out there and you decide, I want to partner with my IRA and go out and buy this property. For example, property's 100,000. You decide you're going to put in 50,000. The IRA is going to put in 50,000. That's perfectly fine because you're both sitting on the same side of the table as buyers. With that, you want to remember, whatever the IRA puts in, the IRA gets back. So in that scenario, 50% of the profits will flow back into the IRA, whether it's a flip or it's a rental, and then 50% of the expenses will be paid by the IRA. So any contractor bill or any property taxes or anything relating to that investment. I do want to circle back and talk about what's called UDFI tax, specifically relating to real estate. I'll give you the example in an IRA scenario, and then a solo 401k scenario as to why a lot of real estate investors like the solo 401k option. So UDFI, unrelated debt finance income tax. UDFI only comes into play if you're going to use leverage or loan to purchase real estate in an IRA. So, as an account holder, you may have all of the money to purchase the property outright, and you just don't want to tie up all of the funds into one investment. Or even if you don't have all of the funds, what you can do is use loan, use leverage. It has to be a non-recourse loan, meaning you're not personally guaranteeing that loan. The only recourse the lender would have would be to foreclose or take possession of the property or the asset if the loan's not repaid by the IRA. So example, 123 Main Street's available for $100,000. You're going to put down $40,000 from your IRA as a down payment. You're going to take out that non-recourse loan, not guaranteeing. You're not personally guaranteeing it. You're going to fix the property up and sell it. When you sell the property, 40% of the profits will flow back into your IRA, or whatever percentage that the IRA puts down based on the terms that the lender's offering. But let's just say in this scenario, 40% will flow back into your IRA without any tax liabilities. However, because you use leverage, 60% in that scenario would be subject to that UDFI tax, unrelated debt finance income tax. Obviously, as you repaid a loan off, it goes away. Anytime there's any tax questions or concerns, I would always encourage you to confer with your CPA or tax professional. And then, of course, in a solo 401k scenario, why real estate investors, especially active investors, like it is, again, if you have all of the money and you don't want to tie it up and you still decide, you want to use loan or leverage, it still has to be a non-recourse loan, meaning you're not personally guaranteeing that loan. Property's $100,000, you put down $40,000 as a down payment from your solo 401k, and then you take out that non-recourse loan, you fix up for the remaining 60%, you fix up the property, sell it, 100% of the profits will flow back into that solo 401k without being subject to the UDFI tax, even though you use leverage to purchase the property. So that's a huge benefit for real estate investors. Let's see. So a question came in. Is the sponsorship able to take recourse loan if the IRA investment is through the LP position and therefore not a guarantor of the loan? Can you elaborate a little bit more when you say, let's see. You mean are you an investment provider or syndicator?
Yeah, I'm not sure if you guys can hear me or not, but that'd be through a syndicated position. Because I think the rationale for that is the IRA can't go negative, right? So you can't be liable for more than is actually in the IRA. But in an LP investment position, you would only be liable for the dollar amount that you invested initially. The loan would be recourse to a primary sponsor or guarantor in the GP position, but the LP position would not be a guarantor. Is that an issue or is that okay?
So as a limited, partner, the IRA is just more so a passive investor. So for you as the syndicator or provider, if loan or leverage, you'll be concerned about, how are you sending the returns back to the IRA investor? Is it coming back passively as interest or dividends? I mean, that scenario, then there's no concern for UBIT for the actual IRA holder. However, based on, how you're reporting on that K1, then they could potentially be subject to what's called UBIT. But in that scenario, I would definitely encourage you to, consult with your CPA who's very familiar with UBIT tax.
So
Thank you.
I'm sorry, I have another question for you. I mean, it's a follow-up from McKinley's question. Can you invest in your own deal, like as a GP and LP? Like can you be GP and bring the funds as an LP from your IRA?
So one of the restrictions that the IRA is prohibited transaction, meaning your IRA is not allowed to transact, with, a business or entity that you own or control. So if it's your own business, then obviously if you have 50% ownership, then that becomes a, it becomes a liability for you. If it's not the company that you own, if it's anything above 10%, then you're really, it's reason to be mindful of that. Hey, you don't want the IRS to come poking around. But typically, if you're the general person, you're the decision maker, you're signing the checks, and you don't want to, cross that bridge. If it's something that it's not a project that you're overseeing, you don't have any control in, you don't have anything above, say 10% influence over that project, then yes, anything above that, then the IRS say, hey, are you swaying? Do you have, are you trying to sway, or do you have influence to sway the investment to benefit yourself personally, or your IRA? So when it comes to real estate options, really it's a broad range. We have at Advanta, we have clients that invest in, if you're more so an active investor, you want to do fix and flip projects, or you want to do, short-term rentals. That's been pretty big for a lot of our clients. Or if you're a passive investor, maybe wanting to invest in a syndication, or, act as, the bank, meaning just private lending. The options is endless. It's more so based on your discretion, what you're comfortable with, and your time and bandwidth. So in addition to, obviously with self-directing, that not just investing in what it also allows you to invest in who you know. So the person on this call can be, someone that you JV or partner with, or, someone that's part of your local RIA group. I would say lean into that, tap into your, your local resources, because it allows you that much flexibility. Some key things to remember when it comes to, purchasing real estate in an IRA. Let me close this out, just bear with me 1 second. It's, the actual asset itself will be titled in the name of the IRA. So for instance, Advanta IRA FBO, which is for benefit of, your first and last name, and then the account number. Again, if the IRA is the only party involved on the deal, then all of the funds from that investment comes from the IRA, and then all of the income generated will flow back to the IRA, and of course the subsequent expenses. If you're in partnership, the IRA allow you to partner with yourself or any other investor. Then it will be split as tenants and commons, and then broken out accordingly based on the percentage of input. Again, as it relates to the expenses, our role at Advanta, we don't give clients tax, legal, or investment advice. We act as the administrator, as the record keeper. As the administrator and record keeper, if there's an expense related to an investment property, you would send us the invoice. We would get that paid for you out of your IRA within 24 to 48 hours. Our clients do have access to an online portal, so you can log in at any time to upload that invoice. You can elect to have a property manager in place. If you do have a property manager in place, they would, take any related expenses and then send the difference to your IRA, to Advanta to be deposited into your IRA. Again, when it comes to managing the actual property, as a disqualified person, you're not allowed to do any of the sweat equity, so you can't do any of the upkeep or maintenance. You can oversee the project, you get to decide what needs to get done, but you would have to hire it out to a non-disqualified person, a third party. I typically tell clients, the IRS is not beating down your door to see if you're making, if you're doing, if you have a person that's mowing the lawn at your IRA's rental property, but if you know the rules, you just want to follow it, it's not worth the risk, Any questions before I transition? I want to go through a couple case studies just to kind of give you a flow of what the process looks like. Okay, so in case study number 1, we're going to do a fix and flip project. We have John Smith. He has an IRA. He has an old 401k of $150,000, and he decides he wants to invest in real estate. It's John's responsibility to go out and find that property. He did. There's a property actually in his neighborhood that he wants to purchase. He understands that all of the investment generated from that property will flow back into his IRA. And then he knows his Advanta is just acting as the administrator for that actual investment. So the process is pretty straightforward with us. First and foremost, John will go through and open up his account. We'll walk him through that process. He can complete the application online. It's done in 15 to 20 minutes. And then of course, we don't have a list of investments for clients to choose from. So John has to go and find it, whether he's driving for dollars, door knocking, He's working with his local real estate agent to find that property. He's going to find the property. He's going to put in a contract to purchase that property. In this scenario, it's for $100,000. He puts in to purchase the property in the name of his IRA. And then again, he has complete autonomy. He decides, okay, it's going to need $50,000 to kind of get it up to par. And then he's going to work with his dedicated account manager at Advanta, who's going to walk him through in terms of filling out the purchase authorization to make the actual investment. And then he has to read and approve, give his consent. Once he does that, at that point, Advanta will work with John's preferred closing agent or closing attorney to make sure all of the paperwork is properly titled and vested in the name of the IRA. Advanta signs signs the actual document on behalf of the IRA, and then of course wire the funds to complete that purchase. Any related paperwork like the deed or any statements relating to that purchase will actually be held by Advanta as the administrator, as the record keeper. And then again, any related expenses, in this case, a rehab project, he will provide us the invoice and we can get it paid out of his IRA account. Just to kind of talk through his strategy, he found the property. He put $50,000 to fix it up. At the end, Advanta will pay those related expenses out of his IRA. He decides, okay, for his agent, he's going to put it on the market for $200,000. And then, of course, the sale, the proceeds from that investment flows back into his IRA case. So in this case, it's $50,000 that's deposited back into his IRA tax-free. Now he can rinse and repeat and go to his next investment. So in case study number 2, talking about partnering on a real estate deal, again, the person sitting next to you or on this call or at your local REIA group, it can be someone that you look to JV and partner with. In this scenario, we have Paul and Linda. They both have IRA accounts or would like to use the IRA accounts to partner together and purchase a rental property. So they have they each have $100,000. They're going to go out and do their due diligence, find the property. They put in an offer to purchase the property for $150,000. They decide it only needs $20,000 to get it ready. They understand the local market, they understand their zip code, and pretty confident that they're going to get $1,500 back in monthly rents. So the process for them, they would go through and open up their respective accounts. We'll be able to walk them through that process. They'll find the property, put in the offer to purchase that property, not in their personal name, but in the name of the IRA. And then, of course, work with their account manager to complete the purchase authorization, read and approve to give their consent. And then at that point, Advanta will work with that closing agent to, send the funds to title everything, make sure all of the documents are in their respective IRAs, and then send the funds. And for the actual monthly, monthly rents, the tenants will send it back to Advanta to be deposited into their account. Sometimes the IRA owner would prefer the tenant send them the check. They don't deposit into their personal account, but they just want the tenants to send them the check just so they can, confirm that the tenants are paying on time, and then redirect those checks, those funds to Advanta to be deposited into their IRA. So in this scenario, because it's a partnership, it's going to be titled as tenants in common. So Advanta IRA FBO, which is for benefit of Paul's IRA, as to 50% interest. In this case, they did an even 50-50 split. And then the remaining 50% Advanta IRA for benefit of Linda. The percentage of ownership is strictly based on, the amount that each IRA puts in. So in this case, they did a 50-50 split. If it was 60-40, then, whatever the IRA puts in, the IRA gets back. All of the income generated will be split between their respective accounts, and then any related expenses would be paid out of their respective accounts. So Advanta, as our role, we would handle making sure if the tenants send one check, split it out accordingly based on percentage of ownership between the two accounts, and then any related expenses. So the percentage of ownership, when it comes to prohibited transaction or disqualified persons, percentage of ownership cannot change if it's, say, husband and wife, say Paul or Linda's husband and wife, and they own the property 50-50, they can't change the percentage of ownership at a later time. They would have to exit out of that deal, and if they decide to in a new investment change percentage, that's different. But the percentage of ownership has to stay the same throughout the life of the investment. So in case study number 3, we're going to talk about investing in a syndication and private placement. we have a lot of, passive investors that like to use their IRA funds to invest in apartment complexes. So in this scenario, we have Jane and Randy. Jane is the person who has an IRA account. She has a brokerage IRA at Vanguard. Randy is the person who's the syndicator. He has an apartment complex that he's going to look to remodel and fix up. And this scenario, it's Jane's responsibility to do her due diligence on Randy, make sure she's comfortable with the investment, make sure she reads through the actual subscription document and understand the terms that's being offered. And then of course, she'll follow through and open up her Advanta account. We'll walk her through that. In this scenario with an existing IRA, she'll fill out part of her application, has a transfer form. Advanta will submit that request to, in this case, Vanguard on her behalf to get those funds moved over. And then of course, she'll work with her assigned account manager. Her account manager is going to walk her through filling out the appropriate paperwork, but also to work with the investment provider. In this case, I'm sorry, it's Randy. So filling out the appropriate subscription document or memorandum based on whatever terms that they're offering. It's going to be titled as Advanta IRA FBO, which is for benefit of Jane Smith's IRA and her account number. And then again, this is not in her personal name. This is being the investment is being made through her IRA. So it's actually going to be using the Advanta tax ID, trust ID, and not Jane's personal social. Advanta will actually sign the documents on behalf of the IRA and then send the funds to Randy to make the investment on behalf of Jane's IRA. And then moving forward, any future dividends or profits that's going to come back from the investment, whether it's quarterly or annually, will flow back into Jane's account without any tax liabilities to her. So the first three case studies we talked about is just more so if you make the investment directly within the IRA. Checkbook control, or LLC IRA, sometimes you may hear it referred to as LLC IRA in our industry. It essentially just means that your IRA actually gets to be, it's the owner of an LLC. In this scenario, you have the option to actually be the manager of the LLC, or you can have someone else act as manager of the LLC. But the IRA or your 401k actually is the manager, is the owner of the entity, the LLC. As the manager though, you have the authority to write a check, pay a bill, sign a contract. So we have Joe, he wants to invest in real estate, but he wants a lot more flexibility, a lot more control. He's a fix and flipper, or he's a tax and lien investor. And even though we're pretty responsive at Advanta, he wants to be able to, move, at his pace. So he'll go through the process, open up his account. We'll walk him through that. He'll be assigned his account manager. He'll also fund his account. So he can, roll funds over from that former employer plan, or transfer from his existing IRA, or, make an annual contribution. And then of course, because he wants to use the LLC feature, Advanta, we don't assist with setting up the LLC. Joe has to take the additional steps of setting up that LLC. He has the autonomy to decide what state he's going to set up that LLC in. He gets to decide what he wants to name that LLC. He'll work with his, his attorney or his CPA to assist with that. And then of course, he'll also draft an operating agreement document. That operating agreement document is going to show that the IRA or the 401k is the actual owner of the entity, the LLC. And this lets the IRS know when this LLC goes out and buy 123 Main Street or does a flip, don't come after Joe personally. Joe doesn't own it. He's just acting as the manager. It's actually owned by his IRA, which is a tax sheltered account. Advanta, as the IRA administrator, will actually sign those operating agreement document on behalf of the IRA. But again, no money move, nothing happens until Joe says it does. So he'll read and approve, give his consent. Once he does, Advanta will then issue a check in the name of the LLC that Joe just recently opened up, or we can send the funds electronically as well, but we'll issue a check in the name of that LLC. And now he gets to go to whichever bank he wants to bank with. So whether it's a big bank or it's a local credit union, he's going to open up a brand new bank account for that LLC. He has the authority to do that as the manager of that LLC, deposit those funds, and now he literally has checkbook control, meaning if he wants to go out and buy 123 Main Street, he can submit a contract to purchase that property in the name of the LLC. Or if he needs to pay a contractor, he can, you write a check or, get a debit card. I tell clients, don't get a credit card. Again, you can't personally guarantee any lines or loans in an IRA or solo 401k. And then of course, if it's a rental property moving forward, instead of having the tenant send the rental check to Advanta, they'll actually send it to Joe in this scenario to be deposited into his into the LLC's bank account. Any expenses relating to that investment will be paid out of the actual LLC's bank account. The LLC itself is a disregarded entity, meaning he doesn't have to file any taxes related to the entity, but we will ask him on an annual basis to give us an evaluation of that LLC. So if he has 123 Main Street in there, hey, what's the tax assessed value on that property, or what's the appraised value on that property? You relay it back to us, and then we report that to the IRS in terms of the fair market value for the asset. Again, just to kind of recap with checkbook control, you have the option to write a check, pay a bill, sign a contract. But you also want to make sure that you work with your competent attorney or a CPA to help you in terms of setting up the LLC on behalf of that's owned by your IRA. When it comes to getting started with us, we've really, just simplified it for you in 3 simple steps. I tell clients, 1, complete the application to open your account. 2, fund your account. You can do it 3 ways or a combination of all 3 in terms of moving funds over from a former employer plan, transferring from an existing IRA, making a cash contribution. And then finally, step 3, start investing. What is it that you have an interest in? It's a broad range of opportunities out there, but if you're a real estate investor, hey, is it, doing rental properties? Is it doing a fix and flip? Is it doing, storage units or commercial or industrial? The list goes on in terms of what's available to you. And then I just want to close it out by, letting you know that at Advanta, we have a lot of educational, events, a lot of guest speakers. So any topic relating to self-directing or opportunities out there, I highly encourage you to check out our website, visit our YouTube channel, Advanta IRA, and kind of go through the recordings. If you have questions, though, don't hesitate to reach out to me. Give me a call. We can talk through your scenario when it comes to self-directing. And that pretty much covers my presentation.